Hi, John and Mary. Thank you so much for taking the time to meet with me today to go over your financial plan. It's been a pleasure getting to know you both on a personal level. The purpose of today's meeting is to provide you with a comprehensive financial plan that best aligns with your financial goals. This financial plan will give you a holistic approach to managing your assets. I'd like to restate the scope of this engagement. As your financial planner, we are to provide you with a statement of net worth and guide you on what insurance policies you should purchase. You specifically emphasize an interest in long-term care insurance and asked us to provide you with a recommendation on which policy to purchase. I am to review your investment portfolio and give you guidance on asset allocation strategies that best align with your willingness to take risk. Lastly, I've agreed to consider the installment sale from the sale of John's business and advise you on tax planning. I believe I've covered the scope of this engagement. If I've missed something, please stop me and let me know. This financial plan will cover the following subject areas: insurance planning, investment planning, tax planning, retirement planning, estate planning, and last but not least, risk management. I will also provide you with a balance sheet analysis and cash flow analysis. At the end of this engagement, we'll go over an action plan to help implement the recommendations I give. In our last meeting, we collected a substantial amount of information to aid in our analysis and creation of your financial plan. First, we provided you with a goal-setting template to help you identify and prioritize your goals. Your goals were the prime focus when creating this financial plan and formulating recommendations. I will now reiterate your goals in order of their priority. Reduce any estate and gift tax liability and ensure all estate planning documents are in order. 2. Review insurance contracts and discuss the implications of purchasing a long-term care policy. 3. Reduce personal income taxes. 4. Using your risk tolerance level, I will recommend a diversified portfolio that meets your investment needs and expectations. In the last meeting, we also had you fill out a risk tolerance survey to determine your willingness to take risk in the market in order to meet your financial goals. Based upon that survey, our findings were that you were very willing to take risk. You also noted that you wanted no investments in tobacco products since both of your parents passed away from lung cancer. It's important for you to know that we will honor that request despite what the market is doing. Lastly, in the previous meeting, we asked you a variety of questions concerning your health, family, circumstances, values, and anything else that would be relevant in creating a sound financial plan. We noted some economic assumptions: a risk-free rate of 1%, a market risk premium of 7%, a market standard deviation of 11%, inflation at 2.25%. We also noted that we expect interest and inflation rates to increase in both the short-term and long-term. The first subject area we will discuss is the analysis of your cash flow statement and balance sheet. Based upon the information you provided, our cash analysis shows that at the end of 2022, your cash inflows and cash outflows were approximately $1.6 million and $370,000 respectively. This leaves us with a net disposable income of about $1.3 million. This gives us a good idea on how our clients save and spend their money. Your net disposable income tells us that you have the ability to save and really invest in your future. The balance sheet analysis shows that your net worth is about $12.9 million. Net worth provides your advisors with an overall view of your financial health. You guys are looking in great shape. One item we noticed on your balance sheet is that you currently have a large amount of cash on hand. This isn't necessarily a bad thing in the event you have an unforeseen event or encounter a huge drop in the market. Generally, we recommend to our clients to keep enough cash in their savings account to satisfy 3 to 6 months worth of expenses. Based on your cash flow statement, your monthly expenses are about $31,000. Therefore, we recommend keeping about $93,000 to $186,000 in your savings account. You aren't carrying a lot of debt, which is great. However, you want to make sure to use the excess cash you have to pay off any credit card balance you have as quickly as possible to avoid high interest rate fees. The mortgage you have on your vacation home will be paid off in less than 5 years, and isn't really an area of concern. A recommendation to improve your financial position is to utilize the excess cash you have on hand. You can invest the cash in the market or set up 529 plans to contribute to grandchildren's college savings. Investing excess cash in the market gives you the opportunity to receive a return on your investment, which will increase your overall financial position. Keep in mind, due to inflation, the purchasing power of a dollar decreases over time. If you aren't growing your money at or above the rate of inflation, your money is losing value. Setting up 529 plans for your grandchildren allows you to reduce potential estate tax in the future. This aligns with your number one goal. 529 contributions are limited by the annual gift tax exclusion amount. This amount is $16,000 for individuals or $32,000 for married couples who elect to gift split. Any amounts gifted over the $16,000 or $32,000 threshold goes towards your lifetime gift tax exclusion amount. You won't have to pay taxes now, but you may have to pay taxes in the future if your estate exceeds the estate exemption. You may elect to contribute 5 years' worth of contributions to 529 plans, which is about $80,000 individually or $160,000 for married couples. In this case, you would have to file a tax form 709 and make the 5-year election. Some advantages of making 529 contributions are that the contributions are able to grow tax deferred, and withdrawals from the 529 account will be tax-free so long as the withdrawals are used for qualified education expenses. Some disadvantages of 529 plans is if you make the 5-year election and contribute $160,000, you must be careful to not give additional gifts in 5 years or else it will trigger tax consequences. If your grandchild chooses not to attend college and you want to withdraw the funds, you will incur a tax penalty and distributions will be included in your gross income on your 1040. That concludes the cash flow statement and balance sheet statement subject area. Next, we will move on to the subject area of risk management. We've looked over your policies, your insurance policies, and have indicated some strengths and weaknesses. Your homeowner's policy for your primary residence is currently underfunded. We recommend our clients have homeowner insurance policies that will cover at least 80% of the home's fair market value. Therefore, I recommend purchasing an additional $220,000 of homeowner's insurance to adequately insure your primary residence. Your vacation home is adequately insured. Therefore, we don't recommend purchasing additional insurance for your vacation home. If your homes are at risk for flooding, we do recommend purchasing flood insurance since homeowners insurance policies do not cover homes that are damaged by floods. Your automobile policy provides you with about $200,000 of liability per person, $600,000 of bodily injury liability, and $15,000 of property damage liability. I recommend increasing the property damage liability to at least $100,000. For health insurance, both of you are enrolled in Medicare Part B and D. It's important to note that Part B and D provide outpatient medical coverage and prescription drugs. Despite you both being very healthy, I suggest enrolling in Part A Medicare in addition to Part B and D. Part A Medicare will provide you with inpatient hospital coverage, which you currently don't have. Since you both are over the age of 65 and receiving Social Security benefits, most individuals can get Part A for free. In the event of an emergency, you want to make sure you have Part A Medicare. According to our insurance need analysis document, you and Mary do not need to purchase additional life insurance policies. You are both in the distribution phase regarding your retirement accounts and have full access to those assets. Between your annual income, liquid cash, investments, retirement accounts, and current life insurance policies, you both are sufficiently covered. However, I do recommend transferring John's life insurance policy into an irrevocable life insurance trust. This policy will then be owned by the trust and won't be included in John's estate, which is currently over the estate exemption, which is currently close to this estate exemption of $12,060,000. This will help meet your goals of reducing estate tax liability. Another one of your goals is to discuss the implications of purchasing a long-term care policy. Please note that your health insurance policy, Medicare, does not cover long-term care, and since you are in great financial health, you would not qualify for Medicaid. Therefore, purchasing long-term health care, is a great way to protect your assets from years long of care. Long-term health care expenses add up quickly and can really take a toll on your financial wealth. Since you both are extremely healthy, I don't believe you need to purchase a lifetime policy, lifetime policy of long-term care. We recommend purchasing a long-term care policy with a 3-year benefit that includes protection against inflation, since healthcare costs will continue to rise over time. Moving on, we will now transition into the investment planning subject area. Your overall portfolio is sound, however, there are a few things I'd like to address. Together, you both have about $3.8 million in non-qualified assets and about $1.6 million in qualified assets. The stock portfolio and mutual fund portfolio fall under the non-qualified asset category. Based on our Sharpe ratio analysis, the stock portfolio combined with the mutual fund portfolio is currently underperforming in comparison to the market. The combined portfolio assumed too much risk without any additional return. The market or benchmark portfolio has a higher risk-adjusted return. As a way to reduce risk and volatility, we recommend you diversify your stock portfolio by increasing the amount of stocks you own. If you take a look at stock A, you can see that over time this stock has generated high losses. As a way to minimize taxes, we will utilize the loss from stock A to offset any unrealized gains by selling the stocks B, C, and D. As of now, I don't recommend any changes to your mutual fund portfolio. However, I would like to do a more detailed analysis. Oftentimes, mutual fund portfolios have high expense ratios and sell charges. There are several mutual fund companies that offer lower expense ratios and little to no sell charges. So we want to make sure you are in mutual funds that make sense. I'll now address your retirement accounts, which are under the qualified asset categories. John's 401k is currently invested in the S&P 500 index fund. This specific index fund is tailored to mirror close to how the market is performing. This isn't necessarily a bad thing, however, based upon your risk tolerance, we typically would like to see you invested in areas that are going to yield a higher return. Mary's 403b account is not in line with your risk tolerance. As Mary nears the retirement age, the 2025 fund has transitioned from a more aggressive portfolio to a more conservative portfolio. Similar to John's 401k, we would like to see Mary invested in areas that will yield a higher return. One way we can accomplish this is by diversifying both retirement portfolios. We have a few options to consider. We can roll over the funds to a new plan if allowed by your current plan provider, roll your funds into an IRA, which could be managed by CBB advisors or another provider, or cash out and pay any applicable taxes. Unfortunately, since our firm is a fiduciary on all ERISA plans, we cannot recommend clients roll their assets into an IRA that we intend to manage for compensation. Therefore, we may only present the options to you and have you decide. Keeping your risk tolerance top of mind, we would recommend your overall asset allocation to be more diversified in about 56% in stocks, 24% in international stocks, 9% in bonds, 9% in alternative investments, and 2% of cash. Lastly, we recommend investing the remaining cash sitting in your bank account in order to improve your overall financial health. If you would like to work with us and agree with our recommendations, we would need to open all accounts listed on the IPS statement policy, on the investment statement policy, and have you sign off on various documents. Next, we will cover the retirement planning subject area of this financial plan. Based upon our last meeting, it appeared that retirement planning wasn't a huge priority. However, we went ahead and prepared a conservative retirement analysis to provide you with the visual of your current retirement state. In this analysis, we increased your annual expenses by $20,400 and reduced your annual rate of return to 6%, even though we anticipate higher returns for your overall investment portfolio. As you can see, your ending asset value is trending upward each year despite an inflation of 2.25%. This indicates that you are increasing your overall financial health and maintaining your retirement funds. In addition to non-qualified assets and qualified assets, you have sufficient income for the next couple of years to fund your living expenses. Your current cash inflows are your Social Security income, installment receivable from the sale of John's business, interest income, dividend income, and capital gains incurred from your investment assets. Therefore, we recommend letting your retirement accounts grow tax-deferred as long as possible to avoid paying more taxes in the future. When you both turn 72, you will each be required to take minimum distributions from your retirement accounts. We recommend withdrawing the minimum for each year to satisfy the IRS requirements and limit the amounts paid in for taxes. In the current year, you may contribute a total of $11,000 to your retirement accounts. Since you didn't have more earned income, you weren't able to contribute the full $7,000 to each retirement account. Your retirement contributions are limited to your joint earned income of $11,000. In future years, you will not be able to make any contributions since you both won't have any earned income. The IRS requires taxpayers to have joint earned income up to their max contribution of $14,000. You won't receive any deductions for contributing to your retirement accounts since your joint income is over the threshold of $204,000. Clients often ask us about converting their deferred retirement accounts into a Roth IRA. If we did that, you would have to pay taxes on all the gains, interest, and dividends the plan produced over time. Since you will be in the highest tax bracket of 37% this year, I don't recommend a Roth conversion. However, once you stop receiving the installment receivable in 8 years, we will revisit the conversation to discuss options. If you are interested in making charitable donations, you could use your retirement accounts to make eligible qualified charitable distributions to reduce your taxes. However, there are a few requirements. First, your retirement plan must be rolled over into an IRA to initiate this transfer. Second, you must be over the age of 70 and a half to be eligible for QCDs. John is the only one eligible for QCDs in 2022. We will discuss the tax benefits of QCDs in the tax planning subject area. If you would like for us to roll your assets over into a rollover IRA account for us to manage, we will need to open up a rollover IRA account for both John and Mary. With our help, we can contact your current plan provider and have them send you a distribution form for you to sign. Once signed, your plan provider will deliver the form to our custodian and your assets will be transferred over without any tax implications. When the time is right, our portfolio manager will begin reallocating your assets in areas that follow our asset allocation strategy. Next, we will cover the income tax planning portion of your financial plan. Based off the facts you have presented us, we anticipate you being in the highest income tax bracket for 2022. However, moving forward, we should be able to get you into a lower tax bracket. In 2022, John received a salary of $11,000 before selling his business and will have to pay self-employment taxes. The $11,000 is subject to Social Security of 6.2 and Medicare tax of 1.45. Therefore, John will have to pay an estimated $841 in self-employment taxes. I'd like to point out the tax advantages for using the installment method in the sale of a business. Installment sales allow taxpayers the chance to spread the capital gain over multiple years as an attempt to remain in lower tax brackets and therefore pay less taxes on that recognized gain. So great job on planning the installment sale for John's business. As discussed earlier in the investment planning section, you have some unrealized losses from Stock A that can be utilized to offset any unrealized gains. This comes in handy when we begin reallocating your assets to match the investment strategy that aligns with your risk tolerance. One thing we can do to decrease taxable income is to invest in tax-free municipal bonds within our asset allocation strategy. This will help lower taxable interest income. Another way to earn tax-free money is to rent out your vacation home for up to 14 days out of the year. The IRS does not require taxpayers to report rental income made in 14 days or less. We may also consider utilizing any gains from Stock B, C, and D to make charitable gifts to qualified organizations in order to reduce your adjusted gross income. Keep in mind that tax deduction limits for gifting stocks is 30% of your adjusted gross income. If you exceed that limit, the excess can't be deducted in the current year, but it can be carried over for up to 5 years. As discussed in the retirement planning section, John is eligible to make qualified distributions from an IRA account. John will turn 72 next year and is required to make a minimum distribution out of his retirement account. To avoid having to report this distribution as ordinary income on your 1040, John may make a qualified charitable distribution to satisfy this IRS requirement. Before making a QCD, consult with your CPA to estimate your ordinary income for the year. This is because an individual cannot make QCDs in excess of their taxable ordinary income. Also, keep in mind that individuals are limited to $100,000 worth of qualified charitable distributions each year. Qualified charitable distributions are excluded from your taxable income and could keep you from being pushed into the next tax bracket. After you consult with your CPA, if you would like to make a QCD in the future, please notify us and we can request a check be mailed out to your qualified charity. Lastly, be sure to consult your CPA on making estimated tax payments, since you may incur a penalty if you are not doing so in accordance with the IRS. Next up, we will discuss the final subject area, estate planning. Fortunately, we will be able to make some quick changes in regards to your estate. According to our analysis, John does not have a taxable estate. However, he is not far from going over the estate tax exemption. If John were to pass away today, Mary would be left with John's gross estate of about $11,870,000, and 90% of his gross estate would be subject to probate. Mary would not have to pay any taxes due to the unlimited marital deduction. However, if Mary soon passed after John, Mary's estate could be subject to estate taxes. Alone, Mary doesn't have a taxable estate, and only about 20% of her assets would be subject to probate. As discussed in the risk management subject area, I recommend setting up an irrevocable trust for John's life insurance policy to help reduce his gross estate, and probate costs. Also, you may want to consider opening 529 plans and making annual contributions to those plans for your grandchildren. This will help reduce your overall estate while investing in your grandchildren's future. Estate planning is essential since the estate tax exemption will be reduced in 2026 to $5 million. Since you both are in great health and your financial wealth will grow over time, I recommend John and Mary open a revocable trust to help avoid probate and the costs associated in the future. A revocable trust is created by a grantor who designates themselves as the initial trustee. The grantor will then designate individuals as successor trustees to act in the event of the grantor's disability or death. Throughout the grantor's life, the grantor has the ability to terminate and amend the trust. Upon the death of John or Mary, a bypass trust will be created to help reduce the estate of the surviving spouse. In order to implement my recommendations, you will need to meet with an estate attorney. The estate attorney will help draft up and implement the legal documents needed for revocable trust and John's irrevocable trust. Trustees will be designated, beneficiaries will be selected, and property titles of assets will be changed and filed to the trust name. Also, be sure to assign a power of attorney so that they may act on your behalf in best interest should you become incapacitated. Lastly, we recommend you assign beneficiaries to your retirement accounts, or else they will go through probate upon the death of either John or Mary. We've discussed all the subject areas of your financial plan. Next, I will prioritize 4 financial planning recommendations that will improve your financial situation and bring you close to meeting your goals. First, I recommend getting your estate in order. In the event the unexpected happens, having your estate in order will help avoid stress and costly events. I can recommend an estate attorney, and set up an appointment within the next week to draft up and implement the legal documents for the irrevocable trust, revocable trusts, and power of attorneys. This will help meet your goals of reducing estate taxes and ensuring that all your estate planning documents are in order. I anticipate your attorney fees to range from $5,000 to $10,000. I recommend you use any available cash from your QCD so long as you won't be penalized from early withdrawal. Second, I recommend getting properly insured. Call your current insurance provider and ask to increase your primary home's insurance policy by $220,000. Purchase flood insurance if your primary or second home are at risk for flooding. Homeowners insurance does not cover flood damages. Also, purchase a long-term care policy with a 3-year benefit that includes protection against inflation. Getting properly insured will protect your life and overall financial health. You can expect your annual expenses from getting properly insured to increase by about $11,000 to $13,000 annually. You may use any cash inflows found on the statement of cash flows to fund these additional expenses. Third, I recommend using your excess cash to either invest in the market or contribute to 529 plans for your grandchildren. If you choose to put excess cash into the market, invest in tax-free municipal bonds. This will help increase your overall financial health without having to pay additional taxes. If you choose to contribute to 529 plans, it will reduce your taxable estate while also investing in your grandchildren's future. Make sure to shop around for 529 plans that offer you the lowest fee coupled with the best investment choices. Select a plan and designate your grandchildren as a beneficiary. You may each contribute $16,000 annually to each 529 plan for a total amount of $96,000. I suggest using your cash on hand to fund these contributions. Fourth, I recommend diversifying your portfolio by implementing our asset allocation strategy that reduces risk, maximizes your return, and aligns best with your risk tolerance. We need to create a joint taxable account, a rollover IRA for Mary, and a rollover IRA for John. We will then begin the process of transferring the stock portfolio and mutual fund portfolio into the joint taxable account once the accounts are open. For John and Mary's retirement assets, we will need to first open the account and then call the plan provider to transfer the assets using a distribution form. You both will sign the distribution form, and the plan provider will send that form to our custodians to transfer your assets. Once all the accounts are open, our portfolio manager will strategically reallocate your assets to achieve our asset allocation strategy. I have provided you with my top 4 financial planning recommendations. Once the recommendations have been implemented, we will schedule another meeting to go over your financial plan and make updates as needed. This will provide us with more accuracy on the success of meeting your financial goals. Should you both have any questions, please don't hesitate to ask. I will plan to schedule our next meeting in 3 months so that you have adequate time to implement the recommendations. Thank you so much for coming in, John and Mary, and take care.